In the United States, banks excel in real estate mortgages, but when it comes to financing business ventures, many bank managers seem unprepared to evaluate or discuss entrepreneurial projects. The system is heavily tilted towards real estate-backed loans, leaving a significant gap in support for aspiring entrepreneurs who lack property assets. Instead of stepping up to the challenge, banks often shift the responsibility to the Small Business Administration (SBA), which fails to provide practical tools to facilitate business loans effectively. This rigid system has caused countless promising projects to fall apart. Entrepreneurs with innovative ideas are locked out of funding simply because they don't own real estate or meet overly strict credit score requirements. Banks must rethink their approach by considering alternative forms of collateral, such as inventory, equipment, and future receivables. They should evaluate the viability of the project itself rather than solely relying on the borrower's personal financial history. The government has a critical role to play in reshaping this landscape. Regulations should be imposed to require banks to allocate a portion of their credit portfolio specifically for business financing. This would incentivize banks to explore new ways of supporting entrepreneurs and foster a thriving small business ecosystem. Banks could finance projects by directly paying for essential business expenses, such as equipment, inventory, or long-term land leasing, and holding liens on these assets. Receivables-based lending could be introduced, where banks purchase future receivables, for example, sales of products or produce, at a discount, applying the proceeds toward loan repayment over time. Integrated systems could monitor the performance of the business, ensuring transparency and reducing risks. Example: a robotics distributor. Imagine an entrepreneur aspiring to become a distributor for a robotics manufacturer. They need $100,000 for securing a location, $200,000 for an initial inventory of robots, $100,000 in cash flow to cover promotional and operational expenses. Under the current system, such a business would likely be denied funding unless the entrepreneur owned real estate. However, a reformed banking approach could pay the landlord and robotics supplier directly, holding liens on the location lease and inventory as collateral. Provide a 12-month grace period for the entrepreneur to focus on marketing and building a customer base. Track sales through an integrated reporting system and deduct a percentage of revenues to repay the loan over time. If any fraudulent activity occurs, the bank could seize the inventory and liquidate it, minimizing financial losses. Another example: tomato farming in New York. Consider another entrepreneur in New York who wants to start a tomato farming business. To get started, they need to cover the area with protective infrastructure, purchase irrigation equipment, fertilizers, and seeds, secure a long-term land lease, acquire farming equipment. With the right banking model, the bank could finance these needs by paying suppliers and landlords directly, purchase future receivables from tomato sales, and apply the proceeds toward loan repayment. Provide a grace period to establish the farm, with repayments tied to sales after a specific period. A balanced approach to risk. While there's always a risk of default, this approach mitigates it by holding liens on the assets and integrating sales monitoring systems. Banks could also introduce credit insurance to cover potential losses. Even if 10 out of 100 loans result in challenges, the success of the remaining 90 ventures would drive economic growth, create jobs, and strengthen the entrepreneurial ecosystem. It's time for banks to recognize the potential of entrepreneurship beyond real estate. By focusing on project viability and leveraging innovative financing models, they can unlock opportunities for countless aspiring entrepreneurs. Government regulations requiring banks to allocate credit for business ventures would be a game-changer, motivating the entire entrepreneurial industry and revitalizing economic growth. This shift isn't just about funding businesses, it's about creating an environment where innovation, determination, and hard work are rewarded. Supporting small ventures, whether it's distributing robotics or growing tomatoes, as the key to building a prosperous, dynamic, and sustainable economy.